When Martin first asked me to come and speak here, I was sure, of course, anytime, Malmö. And then he started talking about what I was actually going to talk about, which was making things happen. And my background is an entrepreneur. I full-time entrepreneur now, VC. I was like, hang on, VCs don't make things happen. They're just a feature. We're just a feature in getting your company up and running. So we're a feature that does wield quite a lot of power. There is money, and if you use us right, we can definitely be helpful, and we can help you challenge. So I hacked Martin's topic a little bit by saying how you make things happen with a VC, because I think this is really all about simply maximizing the output for a company. You're the founder, you're the manager of a company, of a startup, of a more mature startup, and utilizing what's really there and getting access to the VCs and what the VCs can help you with, I do think is enormously powerful. So I'm now a partner at a VC firm in Copenhagen called Sunstone. We invest in Northern and Central Europe, so basically that's a triangle between Stockholm in the far north, Budapest in the southeast, and London in the southwest. We do early stage, so that means we do seed investments and Series A. That's the typical point where we like to start our investment. I'm going to try in the 12, 13 minutes I have to take you through, first of all, looking a little bit at what the early stage market looks like in Europe right now. Then I'll tell you a little bit about the dynamics of a venture fund. And finally, I'm going to go into what specifically we're looking for. And I think each of these are important in understanding where you fit in or don't fit in, and where the VC fits in and where the VC doesn't fit in. So the first thing here is a little bit of data. We did this study about, I think a little bit less than a year ago, mapping out our peer group in Europe. This was, first of all, this is a little graph of who's doing deals with who. And that was sort of the basis of digging further into what was actually happening with investments in Europe. The first thing, which is very, very clear in the past couple of years, is that fund sizes increase. Every venture fund, or if you look at the money has become less, but it's been concentrated on fewer but bigger players. So you see an Excel 5 years ago raising a 250, 300 million euro fund. Now they're raising a 500 million euro fund. And the effect that has is that the average size of a round increases. The more money they get from their investors, the more money they have to return to their investors. And the only way to make that happen is deploying large amounts of capital at once. This then has the inverse effect that seed and A decrease. And of course, we're not looking at a lot of the local players who are geographically limited. But if you look across Europe, this has really been the trend over the past couple of years. And at Sunstone, we are dedicated to early stage. There's a couple different reasons why. First of all, we also made this study in our own interest, feeling that there's a great business case in a market that not a lot of people are attacking. But it's also simply it's more fun to deal with the really early stage companies. What our latest fund was 94 million euros. That says something about we couldn't do a 500 million euro fund and actually focus on only doing early stage investing. A typical fund structure is 5 plus 5 years. It means that in the first 5 years you can actually, of course, if there's anybody who has any questions, interrupt me now and not at the end. It's easier to go over than to have a little bit of Q&A time. So the first 5 years we can invest in new companies, and in the last 5 years we can only do follow-up investments. And ultimately, of course, we also have to liquidate. We have to get out of these investments in order to return the money to our investors. And what this means for an early question. Yeah, otherwise, I'll repeat it.
Hi, Perry is my name. You mentioned that you like to go in early because it's fun and something else, but how do you handle risk in going in early?
I'll get to that. So first with the 5 + 5 years, the thing is, if you're an early stage company and you get in towards the end of the first 5 active years, you're going to have a VC who's immediately going to look at, how can they actually get rid of you again? How can they get their money back? And that's not necessarily a great dynamic to be working with. And so very quickly, for every 250, for every investment we look at 250 companies, and part of that is obviously also assessing, having a big enough pool to assess from simply teaches us what's great around Europe and not just in our own little back garden. We do about 20 deals across a fund. And that, within these 20 deals, we need to return, ideally we want to return 3 times the investment that we have from our investors, so up around 300 million euros. And that means that while you're going to hear many VCs, who say they go for a 10x, what's really important for us is that a star is somebody who can return in monetary amounts half of our fund. So if we have 20% of your company, we want a 250 million euro exit. But on the inverse, look at a large player like Excel. They have a 500 million euro fund. They have a 20% stake in your company. They're going to need 1 billion and 250 euro exit. So there's a lot about the dynamics of a fund. Take 3 minutes to look at that before you actually go in and engage with an investor. They're going to have very different objectives based on the size and also where they are in the lifetime of the fund. So, I think I saw about 700-800 companies last year. Having been an entrepreneur before or having been an active investor before also gives the opportunity to start recognizing some patterns. So we have a bunch of criteria to especially address the risk in the early phases. And I think there's also one thing which people very often, investors and entrepreneurs alike, forget, which is the fact that there's a difference between uncertainty and risk. Uncertainty is, has a lot to do, whether this thing is going to work at all. And risk is more of like, okay, are you going to be able to execute on the indications that you already have? And those are 2 very, very, very different types of parameters. Mark Andreessen has a great essay around product market fit. I like to split out product fit from market fit. Product fit is the point when you have users who are going to kill to have your product, who are going to the Airbnb users are going to be sad when they no longer can rent out their apartments or rent an apartment through Airbnb, or the user who's going to kill to get another of Miley's watches, right? Market fit is when Miley figures out, and I think Miley has product fit right now. Market fit is when she figures out how to scale that, how to get to the market, how to do it in a very, very scalable way. And I think these two are typically pretty pivotal in, at least in raising your first money. That's when you should, at least with the first money, you should be able to prove your product fit. And with your second money, you should be able to prove the market fit, that you can scale this and that you can make a real business out of it. So, some of the things we look for, Miley had the Born Global. People can come discover you, or you can go capture the world. But somebody, and not to pick on Carl down here, but somebody who's just addressing the Swedish market, that's not big enough for us. Of course, he's going to make a killing anyhow, but that's just because it's Carl. I think this is much less of a problem now, but we still do get, I get companies that come in and want to do something around e-learning in Denmark. Not going to be a great exit. The other thing is having something where the product is inherently viral. where you want to share it. Not necessarily viral in the fact that you have to spam all your Facebook followers, but there's something which brings this to other people. For me, a great example are a lot of the different companies that work around content. It could be a slide share that people point to show their presentations, and that creates another user from there. Low cost of failure. We talk a lot about companies being agile and doesn't have to cost too much. Seen from our perspective to be pure and brutal, we're not going to split our 94 million euros into 20 different blocks and give equal blocks to each. We're going to pour our money in where it makes most sense and where we get the highest returns. To get the 250 or the billion 250 euro exit, we can't just do it by splitting our fund up into individual slots. So learning very quickly whether an investment is going to fly or not, I think that's super important. For us, the most important investment is probably the second investment. That's where we really get pregnant and where it's hard to step off again. Double-sided scalability. This has a lot to do with the virality. It's scalable on the input side and scalable on the output side. If you look at a company like Prezi, which is one of our portfolio companies, it doesn't take a big cost of adding another user. And this is scalability on the input side. They don't have to add more man hours every time that's done. The incremental cost of every new user is small. On the output side, it's the fact that Prezi users are sharing Prezis on Twitter, on Facebook, in classrooms, at universities. This brings new people onto the Prezi platform who start creating Prezis, and ultimately some of them end up paying for a subscription. Destruction of existing value chains. Airbnb is a great example, right? The hotel industry. 10 years ago, it was a lot about getting stuff online. It was e-commerce. It was travel agencies who were moving into the online space. Airbnb is starting to disrupt these guys. I think we're going to see these continuous loops happening as more and more marketplaces get fragmented. Spotify is obviously another great example of taking on the existing distribution mechanisms. And where I think we as VCs, we don't understand entertainment value of a game or of a media business coming out of a crowd like this. We do understand elements like this. Every VC is going to say we invest in the team, right? And we say it too. But what the hell this constitutes is a really, really, really difficult thing. And if I'm to boil it down to just one parameter, is having a magnet on the team, having somebody who can attract other great people, having somebody who can attract other great investors, having somebody who can ultimately attract great acquirers. I think this is I can't sit down and write an essay about how this person looks. But when he or she is in the room, and when he or she is not in the room. And it's a fundamental, these people will end up looking very, very different. It's going to be a somewhat, it's going to be somewhat shy Daniel Ek running Spotify, and it's going to be a high energy Tommy Ayles running Podio. But both of them are fantastic magnets for other people and for getting business done. Pulse. If we can get some indications that this business is going, we do investments in pre-launch companies, but that's typically if we have a lot of the other qualifiers checked off at that time. So I think one of the best indicators here is number of links from Facebook or number of links from Twitter. How much are people talking about this? We also use that a lot as a research tool. The way we found Prezi was because we were looking at a competing German company, and up in a Twitter thread popped up Prezi. My fellow partner Christian took a plane to Budapest, and 3 weeks later we'd invested in them. So once we've done all of that, we start digging into the next level. What are your user acquisition costs, your customer acquisition costs? How do you get people in the door? It has a lot to do about scalability. In the later stages, you can compensate by simply having data around the fact that even if you're a traditional software company, that you can go out, you can sell this, you can make it work with your with your account managers and your sales agents. But in the early stages, we want to see that in a very scalable fashion. Retention. One of the this is one of the best indicators of whether you have product fit. Do people come back? Will they be sad if you yank the product from them? These are some fantastic indicators of whether you do have product fit. This is a slightly controversial photo, but once you get there, what are the, especially since we're seeing a lot of free services that are peaking like hell, but have a hard time monetizing. What are the different events that attract, that pulls in the customer, pulls them into the loop? And once we've looked at these things, we start looking at things from a cohort. How many people here know a cohort analysis? So a couple. Airbnb guy, he's definitely getting managed from that. So cohorts is traditionally from the medical industry. You have a group of female 65s. You have a group of female under 65s. You have people who've already had one specific disease before. And when you want to do the testing of new drugs on them, you need to split them up into different cohorts. Doing the same on the web makes a lot of sense. People who joined you in January versus people who joined you in February. What's the retention? Did the improvements I made last month, did they actually pay off? The problem is that if you look only at the forest, and so often I get information and packages from people which only has the aggregate numbers. You cannot see the individual moving parts if you're looking at this big mass blur. So, a very simple one is here. This is an old cohort from Twitter I found. People who joined in July 2007 versus January 2008 and so forth. How likely were they to keep on using the service 1 month, 2 months, 3 months, 4 months after they first joined? This says a whole lot more than the total number of active users on Twitter at any given time. And we end up asking for this information if it's not there, and if we invest, this is probably one of the most important tools. So I think I'm going to wrap it up here. It's for a lot of you here are from the media businesses. I think what applies here, what applies to us in a software company also applies in a media company. A lot of you are getting driven by software components. So I think I don't think it's going to make a whole lot of difference, even if we as VCs, investors, cannot assess whether the game that you're developing is right, or the content play that you're heading out to has any relevance for a specific demographic. So, yeah, I think this part, and it has to do with VCs, as it has to do with entrepreneurs, it has to do with software guys, as it has to do with media guys. Share more value than you capture. So, thank you.